so much for joining us on this beautiful fall day as we talk strategic planning. This is our second part, and understanding financials. I have with me today Jill Clark, who is with SCORE and subject matter expert on all things business planning. We're really grateful to have you with us today. And we're going to go through the slides and understand everything, and Joe's going to do that in a wonderful way so that we all will leave out of here at the lunch hour with a great understanding of the financials when it comes to your business. What say you, Joe?
I agree. That's going to be a wonderful experience. Good afternoon, everybody.
Before we dig in, one of the things that we want to do is to go forward and talk a little bit about the logistics for today. You'll be placed into listen-only mode until the very end of the presentation during the Q&A. If you have a question during the webinar, feel free. You can type your question into the chat window, and we'll see those, and we'll try to get to as many of the questions that you have during this webinar. We're also going to be moderated at the end of the webinar by our very own Melissa O'Connor. We'll be recording today's presentation, so if you're not able to stay with us throughout the entire lunch hour, it will be on the BizLaunch website for prosperity and will be available at the end of this week. Good news, and we'll reiterate this at the end of the webinar, but a lot of the materials that you see and resources that we'll be able to provide will be available as well when we send out additional information with the link to the webinar. If you have any questions later on after lunch and you sit back and you say, oh my gosh, I wish I had asked this question, we do not go away. Feel free, you can come in and actually speak with Joe. He is available here on Tuesdays for appointments, or any of our SCORE business counselors. Or you can contact us here in Economic Development and we can meet with you, because we know it's a lot of information. You may have very specific questions that you're bringing to the table, so we hope to be able to answer everything for you and leave you feeling really good about where you stand in your business planning process. Now, you've heard this disembodied voice. I am Tara Palacios, who's the director of Arlington's small business program called BizLaunch. BizLaunch has been around for almost 14 years now, and we've really enjoyed being here and working with the small business community and bringing topics of interest to you. And I've been working in that time with my collaborator in arms, Joe Clark, who is our business counselor and has a wealth of experience. Joe, I don't know if you want to make sure that people know a little bit of your background?
Sure, I'd be glad to just take a moment on that. Basically, I've been in business, I was in the consulting business, IT consulting business, for about 35 years. I'm a former Coast Guard Academy graduate and spent about 7 years in the Coast Guard before that. When I retired from consulting services, I started my own company just to maintain use of my current my certifications that I had, and I did that on a part-time basis. So I've started businesses, I've shut them down, I've been involved with Fortune 500 companies, I've been involved with small consulting companies. I've seen it from a lot of different perspectives. One thing I would point out for today in particular, you'll notice in all the discussion of my background, there's nothing about being a CPA, an accountant, or having any qualifications for financial statements. What I'm going to be presenting is the perspective of a manager of a business, and how do you use these statements, and how do you get the information in there to then more effectively make decisions, financial decisions for your business. So I will not be giving the gospel according to the accountants. I'm going to be giving the use of these statements from a business manager's point of view.
Wonderful. And I'm also very much interested to hear your perspective as well. And so if you like to chat as you go through, have additional questions, or want to further your experience from today's program, feel free to join us at BizLaunch Chat. I may tweet a few really resonant facts that Joe is able to share with us as we go through. So we're on social media as well, so feel free to interact with us that way. And with that said, I'm going to hand it over to Joe Clark, Small Business Guru, on behalf of SCORE. Thank you, Joe.
Thank you, Tara. Appreciate that. All right, as I said in this introduction session, what I'm going to try and talk about today are the financial statements that you're going to need in order to plan for your business, but also manage your business. And what we're going to be going over are the 3 financial statements that every business plan has to have, and walking through their meaning, their concept, what components are included in those, and then also talking about ways that you can produce your own and tools that we have available to help you in this process. Typically, when customers come in and are told that they have to have a financial plan, they have the deer in the headlights look, and they are paralyzed by that and not able to move forward. And after some discussion, it becomes clear that it's not really all that complex or involved. It's not rocket science. And it is something that is certainly within the realm of every business owner to handle and to manage effectively. So I'd like to get beyond the fear factor, if possible, and get into some discussion of things about what this is all about. Now, to start off for the agenda for this, or the things I'd like to present on the this part of the presentation part of the webinar, I'd like to give just a quick rundown on the context of where the business planning process affects us and how, and this is a repeat from what we did during the part 1 of webinar. So I want to repeat that to keep things in context. So I'll go very quickly through that. Then I want to give information on the 3 financial statements that have to be included in every business plan. From there, that will lead into a discussion of a key element in your planning, and that is, how do you determine the break-even point, that point at which you start to generate profit, where all of the fixed and variable costs are covered. And then finally going into how do you do financial projections and how do you create these statements, and we'll give some information on what resources are available to do that. So that's the plan for this afternoon, and hopefully everybody is on board, ready to go, and we'll start it up. So go to the next slide. And this one's going to build, so I'll just walk through the build very quickly as we go through here. You start off with some product or service that you're offering, and you know that that's going to be for a particular market, and you try to identify that market. From there, you find out who else is offering competing products or services and try and identify that competition. You then come up with a plan on how you're going to let the world know about what it is that you're offering and how you're going to position yourself against that competition. From doing that, you come out with a projection or targeted sales levels that you're going to be making. How much are you going to sell, by when? So that you can then go into the next part, which talks about how do I lay out all the operational plans, things like hours of operation, staff that I need, what organizational structure is needed, what resources will you need to pull together to deliver those that sales projection, all of which will drive the financial analysis that says how does this is this profitable or not. When you go through this, you'll find the first cut probably is not going to be an acceptable answer. You'll find there's something you need to do to change. Either you're operating at a loss or you're at such a high level that you'll never get the resources to be able to do this. So what you do is the next step is you then loop back through this again, and as you iterate through this, you will continue to refine things, get to the point, your aha moment that says, hey, this is something that I can do. What the important part of understanding the context is, when we talk about the financial statements, while they're certainly impacted by all things like what product or market you're going after or what the competition and plans you have, they really are referring to the bottom half of that that says, here's my projected sales, and here are the costs, the organizational and resource costs that you're going to have available in order to deliver on those sales. And that will drive the information you see on the left of the slide, which are the 3 financial statements that we'll cover today. We've got the profit and loss statement, the cash flow statement, and the balance sheet. Those are the 3 statements that will be required of you by anybody reviewing your business plan. From that, we get into the break-even point and the benchmarking to others, as well as understanding what information you need to get things started up. All right, so that is the introduction and the context setting. Let's go ahead and go into the financial statements. The first one I'm going to cover is the balance sheet. And it's nothing more than somebody's asked you a question, how much is your business worth? And mentally, when you are asked that question, you add up all of the things that you own, OWN, and you total up all the things that you owe, OWE, and the difference between those is what the business is worth. In a nutshell, that is the balance sheet. It's for a specific point of time, and it says at that point in time, set January 1st of the year, here's the things that you own, all your assets, then how much do you owe people in liabilities, and the difference is the net worth or the equity that you have in the business. Now, this next comment is based on an accrual basis. There's 2 ways of accounting systems recording information. There's the accrual basis, which says as soon as you know about a transaction, you record it in the system, even if that is not going to happen until 3 or 4 months down the road. The opposite is the cash basis that says until money changes hands, it doesn't happen. So you might be on a cash basis until you paid that invoice. It's not a real invoice. Until you receive the money from the customer, you haven't made a sale. It's just 2 different ways of looking at this, and the accrual basis takes more of the future events into effect. And it's important to understand that, especially in the liabilities aspects of knowing what you owe and further out. So this statement is done on the accrual basis, and the main components of it are the assets that you have, the liabilities, and the owner's equity. Now, the only other thing we point out on this slide is we talk about current and fixed, or short-term and long-term. You'll hear for liabilities, you'll hear people say current liabilities as well as short-term liabilities. Terms are the same, but obviously current needs to be defined, because that could mean one day, it could be the next week, it could be anything. In the accounting systems, it's the next 12 months. So whatever is going to happen in the next 12 months is the current, either asset or current liability. That's just something that you've got to remember on that. All right, so with that in mind, we'll go to the next slide. We'll talk very quickly. Again, I want to give definitions of these 3 statements. We'll get into the income statement. The income statement is a little bit different, because now what it does, it says over a period of time, a given period of time, either a year, a month, whatever you state, during that time, was the company making a profit or a loss? And we determine that, again, using the accrual basis of accounting. We are going to look at all the revenue that you've generated minus all of the expenses that you had, and that's going to determine whether or not you have a profit or a loss. The main thing you're trying to do here, what's really critical in the income statement, you want to use the same buckets as everybody else, because things like revenues, cost of goods, all the things you see listed here have very defined meanings, and everybody uses them the same way. And by doing that and keeping things consistent, you have comparability of your operation to others. And it's a matter of getting the right structure for that so that you can come out with the same statements as everybody else. But basically, you start off taking all the money that you generate by sales, that's the revenues that come in. Now, there is money that you are spending. Think of this as money that goes out of the company's, out of the pocket of the company to somebody else, that's for the goods that you're selling. It may be for the products that you're selling, where you are being provided those products by a supplier or a wholesaler, for example, and you have to pay that. It could also be things like when I make a sale and I do a credit card swipe, the swipe fee is the cost of that sale. So I have to account for these things that are associated only with making that one sale. And it gets a little bit tricky in some cases. In consulting, which is my background, we had cost of goods if we would hire an independent contractor, a stringer, to do some work. If we didn't have the job, they wouldn't get hired. So they would become a cost of goods sold. So it takes a little bit of thinking, but it all falls together pretty well. The next thing you have is all of your operating expenses. Those are the fixed costs that you have, things like salaries, your rent, your insurance that you're paying. All those fixed overhead items are your operating expenses. And that's when depreciation is really it's a book entry versus actual dollars typically. But the IRS says any fixed assets that you have can be replaced, and they say how long they expect that asset to last, and then you are able to take a write-off for that item to replace that item over the period of life. So let me give you an example. If you have something that's a 7-year period, useful life, then you take 1/7 of that price and subtract that as a depreciation deduction. And you're able to write that off, even if you don't take the money out and put it off separately. You're allowed to write that off as an expense, which will then decrease the amount of taxable income you'll have at the end. So it's a valuable asset, but something to just be aware of. Depreciation is basically an allowance to replace the fixed assets that you have. Interest expense, depending upon what type of loans you're taking out and what type of interest you carry on that, the interest expense gets added at this point. And then finally, it's the taxes. And these are the taxes that the company pays, not the pass-through taxes, not your personal income tax. So if somebody, for example, has an LLC and they make that a pass-through entity, the company pays 0 tax. But the individual has personal taxes as a result of their business. In this case, on the income statement, you would put 0 because the company is not paying that tax. All right, so let's go ahead and take another look at this. And we just put it together as a formula, and what you have is you take your revenues, you subtract those cost of goods. What's left over is a very important number that you want to focus on. It's called the gross profit or gross margin. And what this one is saying, here's how much money your company has to run the business after you've paid your vendors or any fees associated with making those sales. What happens is that this tends to standardize for different segments of the industries. For example, restaurants typically have a gross profit of 70%. And that means if you spend $100 in a restaurant, $30 is going for cost of goods, and the restaurant has $70 to pay its staff, its rent, and all of those other expenses that it has. You'll find different industry slices tend to have the same gross margin. And that's one of the things that you want to consider as you're putting your plan together. What are your gross margin, and does that match up with what the industry experience would be? Next item then gets into your operating expenses. You subtract those, and your depreciation for the assets that you're replacing. What's left over is an operating profit, which is basically how efficient is your organization is what I look for there. From there, you take out the interest and the taxes, again, company income tax. And what's left, that tells you how efficiently are you using your financing. At the bottom line of this is net income, net profit. And it basically is that's the profit or loss that the company makes. So a couple of things that I've mentioned here. One, somebody says their company made 5% profit. I would first question him, well, okay, what type of profit are you talking about? If it's net income, that may be okay. If it's gross profit, that may not be too good. So it depends on which profit they're talking about, and you need a little bit more definition so you can understand whether that's a good item or a bad item. All right, let's hit the next one, cash flow. Everybody is familiar with maintaining a checkbook register where you put in how much money you had in the bank account to start with, you write in how much you add for deposits, and you write in for each check. You have a running balance that says what's left over. But that basically is the cash flow statement for your business. And it's typically done on a monthly basis, but it covers a period of time, and it says, here's how much money came in, and here's how much money went out. And obviously this one is the one that's not going to be done on the accrual basis. This is done on the cash basis. As soon as the transaction hits and the money changes hands, then it goes on this statement. Now you may have cash from a number of different sources. One may just be from your sales or operations, but you may have some money that you have as part of your investments that are part of the business. That you may, for example, you may take out a CD on some cash that you have that you're not using, and you would earn interest from that investment. Or you may take out a loan or pay off a loan, and that will have an impact on the financing activities. All of these will impact your cash flow statement. What happens in most small businesses, what I see as being the most important statement really is the cash flow statement. I've seen many cases where people buy a piece of equipment because it really looked neat, but it may be expensive, but boy, we're going to make a lot of sales on it once we get this equipment in here. And then they buy another piece of equipment, or they buy some other asset. And what happens is they become asset rich, but cash flow poor. And then some unforeseen bill comes in, and what they have to do is liquidate one of those assets, and they'll guarantee you're not going to get the price you paid for it. So the main part you want to do as a small business, especially a startup, is pay attention to your cash flow statement and make sure you're carrying enough cash in that to make payments for any unforeseen expenses that come up. All right, so let's go ahead and put this all together. So here's our balance sheet. And just like you would an old-time scale, you've got assets on one side and liabilities and equity on the other. This makes the assumption that you're operating in positive equity. That's not always the case. But basically, you have all those current assets, fixed assets, and other assets you might have. And there's a number of things that might qualify as other assets. From there, you're balancing that with your current liabilities, those over the next 12 months, plus any long-term liabilities. What's left over is going to be your equity. So that, I think, makes a lot of sense to most people when they see it as a balance statement. And it's for that particular point in time. What's going to happen as you're going along and operating your business, your operations are going to change these numbers. As you can see with the next build, that's where the income statement comes in. The income statement, you have your operating revenues minus the expenses and the net profit. That's going to have an impact on your balance sheet. Well, not the prior balance sheet, but the next balance sheet that you do. So if we take a look at this next part, you can see there are impacts where the net profit, when you're making a profit there, it's going to increase your owner's equity. But you may also be doing things with assets like writing depreciation off as an operating expense. So you can see there's some interaction between these two statements. The next build brings in the cash flow statement. And from there, you can see what happens is as I manage my assets, that's going to generate cash flow. As I operate my business, it's going to generate cash flow. And when I manage my finances, it's going to generate and impact cash flow, all of which is going to come back up and impact what I have for current assets.
So it's all kind of working together.
Right. there are two takeaways on this that I really want to emphasize. The first one is, as Tara says, that these are all interactive, so one impacts the other. The other takeaway is you need all three statements to say what this business's financial situation is. If you only have one, you don't get a complete picture. So you need to see all three in order to say whether or not what's the financial condition of this business.
It's almost looking at your business landscape.
Right. You're looking at the same numbers, but all from three different perspectives. Right. Three different angles, and that's what gives you the complete picture of what the business is doing. Okay?
At any given time.
Right. Or any period of time. In this case, the profit and loss is going to be over typically over a year. All right. Now, the reason you go into all of this and look at all of these things is make the management decisions. One of the management decisions you got to make is how long do I have to operate before I start generating profit? And if you don't know that, that's a good word. It's a good word, right? And if you don't know that, then you may be in trouble. Now, one of my advice to people is don't just pay attention to the rules of thumb that you hear. People say a business doesn't have to be profitable for 2 years, and that all depends. It depends on what type of business and really how much capital investment do you have.
Nice.
I would say a consulting company should be profitable right away.
Because the overhead's not
There's
there.
very little. You got to print cards up and put up a website, and boom, you're there.
Okay.
But something like a restaurant or something like a retail store, there's a lot more investment in that, and it's going to take longer to pay that off. So avoid the rules of thumb, or the generalizations that people throw out, and you've got to look at your own situation to decide what makes sense for you.
And nowadays, there's so many different types of businesses that you have very unique, so some of these rules of thumb may not apply.
Right. And I find my problem with many of these business wisdoms that you hear they are generalizations, and they don't normally come along with the details of what makes that statement true. So that's why I would want to avoid that.
Oh, that's a good bit of advice, Joe.
But let me walk you through the break-even point and how you determine that. In order to understand break-even point, you have to first think about every expense that you have is going to fit into one of two categories. It is either going to be a fixed expense, that's a predetermined expenses, things that you know I'm going to be paying this, and it doesn't vary based on the amount of sales. So things like your rent, things like your salaries for people for the most part. You're going to be having a fixed expense that you pay, and you're going to pay that regardless of whether or not you're making sales. The other one, the variable expense, really fluctuates as a function of the sales. So as you make the sales, then you incur that cost. We talked earlier about the cost of goods. Those are your variable expenses. Things like the product that I sell, I'm not going to replace that product in inventory until I make a sale. So until I make the sale, it's not a cost to me. The swipe fee, the example of it's a variable cost that I'm only going to make if I make the deal. The stringer's fee for the part-time employee, the independent contractor I hire to do something, might be a variable cost if I'm not going to hire that person unless I've got the job. I may have independent contractor costs that are fixed costs. If I hire a cleaning crew to come in and clean my shop every day rather, not every year, that's bad, every day.
That's a lot of days.
Right. And that's a fixed cost because I'm going to be doing that regardless of the sales that I make.
Okay.
So the big thing to keep in mind when you're doing your calculations is any cost that you record, is that a fixed cost or a variable cost? Now, given that, then the next slide will show there is a method that you can follow to do an analysis to say what the break-even point is. Break-even point is that amount of sales that you make such that all my fixed and variable costs are covered. I will give you the formula here, but rather than trying to memorize the formula, let me walk you through on the next couple of slides an example of this. So let's say here I have in my analysis, I've got sales volume on the vertical, the x-axis. I'm sorry, the y-axis, right? The x-axis is the number of units that I'm selling. Okay. So the first thing you got is a bunch of fixed costs. Go ahead. And obviously those don't change based on the number of sales I make. Then I've got on top of that the variable costs that I have to add to those fixed costs, and that gives me a total cost that I've got to pay. Now, when I'm setting up my price and my sales price on this, I can't go to the first customer and say, we're very excited to make our first sale here. By the way, you have to pay all the fixed costs, and then we'll give the variable costs on top of that. So what happens is you pick out a price that you're going to charge a customer. Go ahead. And you do that per unit. You're going to have the sales are going to then be a function of how many units you sell. At some point, you can see the dashed line crosses the green line, okay? And that's the break-even point.
Right there.
That's the one that we're concerned about.
Okay. Where I'm putting that pointer at, right?
Right. Okay. Now, the reason you're concerned about that, because until you reach that, you're operating at a loss. Remember, in business, loss is not good.
That's right. We don't like that word.
So let's go for the good word on the next bill.
That's positive.
There's profit.
All right.
That's what we're looking for.
On the other side.
Right. So we've got to get to that point in order to start generating profit. Okay? So let me walk you through an example of this. Let's say you rented a space for $2,000 a month. You're a consulting service, and you're basically selling. You've got a staff, and you're costing you about $8,000 a month. And what it's costing you for your staff, or the unit of something you're also selling a product, and that's going to cost $100. So that's your COGS are $100. But you're able to charge $300 for this product or service that you're selling. So using our formula, you have my total fixed cost for the month are the $2,000 and the $8,000 for $10,000. Now I express my cost of goods as a percent or as a decimal, so it's 100 over 300 or 0.33. And that's 1 minus that, so that you do the math and you come out with $15,000 in sales in that month will reach the break-even point. When I know my unit cost is 300, then I need to sell 50 of these. Just if you put on the next slide, we'll put it up there just visually showing where that is, and you can see from the next build that we got the 10,000 is my fixed cost, and 15,000 is the unit is the break-even point for the 50 units that we sell.
So anything, Joe, that's over that 15,000 is additional profit that you could potentially make.
That's when you're starting to make profit. Remember, your costs are going to keep going up because that green line is your total cost.
That's my total cost right here.
So I make 20,000 in sales. I don't get 5,000 extra profit. I get 5,000 minus my variable cost.
That's the trick, because I have to be able to.
But until I reach that break-even point, I know for a fact I'm operating at a loss. After that, I start generating profit, but it's not all profit after
because
that.
I have to make consideration of some
for the cost of goods sold.
My cost. Okay.
My fixed costs have all been paid, but now I still have to pay the variable cost. So what's important is that your organization has to understand things about this and have it in their DNA that they're motivated to reach that break-even point.
So I think the natural inclination is that once I've reached that, then everything else is profit. But I still need to consider my cost.
Right. You're going to be able to, what will happen in financial terms is the gross margin is all profitable, but not the sales.
Gotcha.
But what you want to do is do things like if you're in a retail store and if your break-even point was $15,000 for the week, and if you reach that, fry pizza, do something to celebrate, and give everybody the motivation of thinking, keep them in the mindset of reaching that break-even point.
Okay.
That's the idea.
And not to fall beneath that.
Right.
Constantly go.
Right. Always strive to exceed that.
Okay.
And a break-even point can be done for a month, it can be done for a year, it can be done for any period of time. Just allocate the fixed and variable cost to that time slot, and then you can calculate the break-even point.
And then have the whole team understand what that is, so everybody's clear as to what they're working toward.
Right. Keep everybody moving toward the goal of making this a profitable concern.
Okay.
Right. Okay, so on next thing, what I want to mention here is I'm giving you a website as available on score.org where you can go to and get financial projection templates that will walk you through building the financial statement. It will generate the 3 financial statements for you. We do it on a 3-year out basis. So you put in your projection of cost, your fixed cost and variable cost and the sales projections, and then it'll crank out the financial statements for you and give it to you all in the right form.
Very nice.
What it will do also, it'll work calculation for the break-even point. It'll give you a point where you can then do some additional research and give benchmarks to financial ratios for other companies in your sector, like the gross margin and the rest of those things we talked about. So you can compare yourself to others. But then it will also run a diagnostic that will look at your financial statement and say, hey, does this seem in line or does this seem out of line?
Very nice.
Let's also, we have a 50-page guide that walks you through creating the statement, and that's available in English and Spanish.
Now, is it intimidating, Joe? You say 50 pages.
Yeah, but remember, what it is, it walks you step by step and says, okay, in this space here, fill in this number, and here's what we mean by leasehold improvements. Put in your estimate for that. And I find people, when they take it bite by bite, are able to answer most of these questions and put this information together.
Okay.
You can fill out the guide, and then from there, use that to fill out the template, the spreadsheet. And that's an easier way of doing things. So it doesn't have to be very intimidating, is what it comes down to.
You can break it into buckets so that you can get the information you need.
And again, this is not rocket science stuff. This is stuff that people are able to handle once they understand what are the component steps that they're trying to figure out. And I find that's been the biggest stumbling block. If they just told they have to come up with their financial statement, that's overpowering. If they understand that they've got to say, okay, what does it look like your fixed costs are going to be? What are you going to have to pay for staff? What are you going to have to pay for your vendors for what you're getting? And how many of these things do you think you can sell? Those are all questions that people tend to be able to come up with answers on.
That's right.
And based on that, then putting it in the right form and cranking the numbers, and that's the easy part. And that I would let the spreadsheet do.
Okay.
All right, so some contact information here, so make that available. If anybody has any additional questions, I'd be glad to try and answer anything we can.
Okay.
We can make the spreadsheet template available as well as the guide. And we can provide information on how to get that in the email that you send out, right, Sarah?
Yes.
Okay.
We're going to share that information today with everybody, and I can't emphasize enough that Joe and team of mentors are here to kind of walk you through. I think one of the most important aspects of business planning is actually making sure that you get these numbers right. Because if the numbers are wrong, we don't like to think about that.
I think there are 2 parts that I'd like to offer comments on that. One is that you got to get, I say get the numbers first.
Before you start with the
Before
plan.
you start writing a plan.
Okay.
And I say that, well, 2 reasons. One, I'm a numbers person, but more importantly, once you put together your numbers and you got your aha moment of what I think I can do, then your marketing plan has something concrete to talk about. Now I need to get 15 customers in the first year, or I need to know I have 100 customers that I got to bring in every week, and then what type of marketing am I going to do to reach that number.
So it takes that kind of unknown and then makes it kind of known in something that you can attain because you know what the success factors, what that break-even point is going to be.
You're talking about things in the right context as opposed to generalization. When people start writing the business plan in general, they start talking about, they put in 20 pages describing the market and what the demographics are, and that's misplaced effort. Especially when you're trying to get less than 0.1% of the market. So why spend all that time describing the overall part of the market? Just do a reality check that there is a market, that there's what the competitive landscape is like, but don't go into tremendous more detail.
Yes, I guess it doesn't make sense if you have an assumption about the market and you know you really need to know what the opportunities are. And I think this is where the second part of strategic planning is probably even more important than the first part.
Well, I view it as a starting point for that. And so I'd like to start with the numbers and get something that is a realistic plan that's going to be profitable and sustainable. And the second aspect, I would say, is bring it in and have other sets of eyes looking at it.
Somebody that's third-party neutral.
Somebody who's not involved.
Not in the family. Or wants you to succeed unduly.
And not a competitor who wants you to fail.
True. Call up somebody in the industry. Hey, what do you think about this? Right.
So get another set of eyes to look at this and do a reality check. Have you missed anything? Are there errors of omission? Are there things that you're being overly optimistic about? And have that question. And obviously, we can do that here in BizLaunch and SCORE, so we can serve that purpose.
To have that.
The other comment I would make is, and my hesitation in sending out the spreadsheet is, as with any tool, if you don't have support in how you use it, you can come up with any numbers you want.
I can make a number look good, Joe.
Oh, yeah,
I'm a marketing person.
We can take these and we can make every business plan very profitable.
Right.
Now, the reality check may be a different thing. So.
And that's where you guys can come in and really make sure that it's a feasible number and to find out where did this number come from. Because I think maybe one of the challenges that folks that we work with as they're launching their business, it's like, but I don't know what those numbers may be.
Right. And the other aspect that happens when you start doing this is you can use things like the financial ratios to fill in numbers you don't know. So, for example, if the industry as a whole is spending 3% on advertising, you may not know what number you need, but at least you have a starting point. Or if they
start to get an idea.
Right. Or if you know how much you're spending for wages and salary, then you can use that information to give as a budgeting point to start with. And you can fill in some of the things that you don't have a clear idea on.
Okay.
So there's a lot of ways you can make use of it. But the main part of it is you got to play with the number, you got to put it in, see what the numbers do, and see whether or not it's going to be profitable. That's what you got to answer.
Okay. So we'll open it up to questions. I know we went through the model, and I saw a couple of questions and raised hands. So I'm going to go over to my colleague in arms, Melissa O'Connor, and check the phone lines to see if we've got any questions.
Yes, we do. We have a few questions, so I'll just jump right in. Our first question is, how do we best compare business plan soundness against the industry current standards?
Oh, that's a good question.
This is, I didn't hear the whole part. Business plan standards, right?
Yeah. How do you best compare your business plan soundness with business plan industry standards?
Okay. There's the thing that we call financial ratios. And what the financial ratios are predetermined means of comparing different aspects of the business plan. Things like the gross margin is one, net profit is another. Turnover of your accounts receivable or accounts payable. There are a number of these that typically fall into 4 different categories. They're either going to be an area of liquidity. Do you have enough current assets to pay all your current liabilities? The second one is going to be operations, how profitable things are. Third is going to be how well do you leverage financing. That'll be things like your debt ratio. And then finally, just the overall, I'm having a mental cramp here, almost the last one was. But I think the operational, financing, liquidity, and I'm missing one. So I apologize.
It'll come to
Yeah, it'll come to it. But there are 4 categories of different financial ratios. And anybody, any gatekeeper looking at your financial plan is going to compare your plan to them, and they'll run those financial ratios and look at your numbers and how do they compare to them. Now, what we do on our spreadsheet template is we'll do all those financial ratios for you and then give you a place to record what the industry part is. And you get that by doing research. The publication put out by the Risk Management Association, RMA, that publishes financial ratios for different NAICS codes and puts that information out so you can pull that and compare yourself before you submit it to the approval person, because if they ask a question, you've got to have an answer ready to go.
Okay, thank you. The next question is, what do you find is usually the weakest part of someone's business plan when they're first developing it?
If we're talking about the financial part of the business plan, then I would say the weakest part is the sales projections. People get a pretty good handle. They can come up with estimates on their costs. They can estimate their staffing. They can even do the cost of goods sold fairly well. But the weakest part is what type of sales projection. They've got to walk through an analysis that helps. You've got to be able to defend your sales projection and show that it wasn't just a optimistic estimate as opposed to a realistic one. And when I work with people, I recommend they underpromise and overdeliver. So you should recommend very conservative sales projections and then go ahead and overdeliver on that. You'll find nobody's going to criticize you if you make too much profit. They will criticize you if you don't make the profit you said you would. So from a financial statement, the financial part of the business plan, the financial projection, the sales projection is what I find to be the weakest area. From the business plan as a whole, what I really find the weakest part is people focus on the technology of the product or service that they're offering and spend pages and pages trying to describe that, and very little in talking about how they're going to manage the business, what are they going to do to run the business to make this a profitable enterprise. So depending on which, whether it was the business plan or the financial plan that the question was about, that you can pick which answer makes most sense.
All sound advice.
Great, thank you. And then we have just one question that's asking to clarify. What was the name of the organization you said that publishes the ratios?
Yeah, that's the Risk Management Association, RMA, and they have an annual statements. And the best way of getting that is to go to the Arlington Central Library and talk to Alexandra Fox. And they subscribe to the RMA, and that RMA will give you the financial ratios. Now, a cheaper, or let's put it this way, easier online tool you can use is bizstats.com, bizstats.com, and that'll give some of the high-level things. So you might get the gross margin and the net profit from that, but it doesn't get into all the details of the rest of the financial ratios that you can get through the RMA.
And I guess, too, when people are looking, to kind of get these ratios, just so folks are aware that the banks actually, after they read your plan, they'll cross-check them with some of these tools to make sure that the numbers are, especially for first-year numbers, are accurate.
But definitely the banks subscribe to RMA, and they're going to have that available. And two things that matter on that. One is when somebody asks you a question about one of your financial ratios, if you don't know what they're talking about, that'll be a negative.
That deer in the headlights.
Right, exactly.
What?
And there could be very valid reasons why your ratio is different. But number one,
You
you need to know
up.
what the ratio is and how it compares to the industry. Because it's,
The industry standard.
you've got to be able, well, it's not I've drawn a distinction between industry standards because the industries don't have a standard that they go to. They just say, given all the people in this industry, here's what their financial ratio comes out to be. So they're not saying that they're aiming at 30% cost of goods. It's just what the experience of that industry slice is. So a minor rewording of the expression, that's all.
Okay, great.
Any other questions?
We have another one that asks, if you don't have your first year numbers, is it okay to use estimated guesses?
Yeah, keep in mind that most of all of what we're talking about here are typically your pro forma financial statements. So if you have any experience, that's valuable, but you can fill out these projections and these statements all based on your expectations of what the business will be doing. And that becomes your pro forma. Just means that you're making a projection of what the business will be doing. If you don't have any prior year experience, and startups by definition do not, then you have to be able to defend what assumptions you are using in order to create your projections.
Okay. I think that's all the questions that we have. One of the things that I would recommend with BizLaunch, we have a number of events coming up next month on financing, which kind of leads in from the business planning part, and now we're going into, what do you need to look at insofar as numbers. Right. One of the first events that we're doing, Joe, is a credit clinic. And so if you haven't taken a look at your actual credit report, we're going to be pulling reports and talking through that process, which leads into going back into making sure the numbers are spot on, but also following that up to make sure that your business is healthy, you're looking at your profits and loss.
Yeah, and I think what people get concerned about when they start talking about financing their business is coming up with what number they need to be going after.
That's right.
And use the spreadsheets, use the tools, because what you need to be talking about are any of the startup costs that you need, things that have to get paid in order to get the doors open for business. That's one chunk of money. The other is, what money do you have to have in reserves to cover the point until you reach a break-even point? You're going to be running at a loss, and you've got to cover that. So you need funding both to get the doors open, but to operate the business until you generate a profit.
That's right.
Now you can use the tools here to come out and quantify and give the actual numbers of what you need in both those areas. Keep in mind, the lenders are going to want to see how much of that's coming out of your pocket.
That's right.
And if they don't see a sufficient amount, then you're playing with other people's money, and that's not going to go over well. But you can use these tools to estimate that and get away from this, gee, I think I'm going to need $100,000.
Not quite sure.
Yeah. You've got to be able to say, not to the penny, but you've got to be able to say, here's how much I need, and this is why I say I need this amount.
And I can back it up statistically. And
show them the pro forma statements and say, here's how I know how much I'm going to need.
That's right. And so I can also emphasize to everybody that's here on the webinar that Joe is available for appointments. I know I said that earlier, but I have to reiterate that. I know I'm not really a huge numbers fan, but he's really great. And like he says, he loves the numbers. He really does. So if you need any kind of assistance and help, definitely reach out to us. We want to thank Joe Clark for being here with us and thank you, the audience, for sharing your lunch hour with us. We hope you were able to get some really great insights, and we will be sharing the contact information out with everybody very, very soon. Joe, did you want to leave any parting words of wisdom? Well,
the only thing comment I make is, this is not difficult work. This is something that everybody can do, and with a little bit of effort, you can put together a very professional, very well thought out financial plan as well as a business plan. But the other part of it is, don't do it alone.
That's right.
You got a lot of people that are available, and our price is pretty competitive. This is free.
Free's not a bad four-letter word, right?
And let us help you.
Fabulous. Thank you all. We appreciate you being here, and we look forward to seeing you at another BizLaunch event in the very near future. Have a wonderful day.